Have you ever wondered how to participate in peer-to-peer lending? Well, today, we're going to delve into that very topic. Peer-to-peer lending, often abbreviated as P2P lending, has revolutionized the world of finance by creating a virtual marketplace that connects borrowers and investors directly. This innovative model bypasses traditional financial institutions, thereby streamlining the lending process and often providing a win-win situation for both parties involved. So, how does it work, you ask? Picture this: you're an investor with some extra money you'd like to grow. On the other hand, there's someone out there who needs a loan, maybe to start a business or pay for an unexpected expense. Traditionally, you'd both go to a bank or other financial institution. You'd deposit your money and the borrower would apply for a loan. But in the world of P2P lending, you connect directly. The borrower gets the loan they need, and you, the investor, earn interest on the money you've lent. One of the primary benefits of P2P lending is the potential for higher returns. As an investor, you can often earn more interest than you would through a traditional savings account. And as a borrower, you may find that P2P lending offers more competitive interest rates than banks or credit cards. But that's not all. Peer-to-peer lending also promotes financial inclusivity. It opens up avenues for borrowers who may not meet the stringent criteria set by traditional lenders. This model democratizes access to credit, making it possible for a wider range of individuals and small businesses to secure funding. So, we've talked about what peer-to-peer lending is and how it works, as well as some of its benefits. By now, you should have a basic understanding of this innovative financial model. But we're just getting started. There's so much more to learn about P2P lending, including how to participate and what to consider before you dive in. Now that we have a basic understanding of peer-to-peer lending, you may be wondering how to get started. Well, stay tuned, because that's exactly what we're going to explore in the next segment. Getting started with peer-to-peer lending is simpler than you might think. It's a process that can be broken down into 4 main steps. Firstly, it's all about choosing the right platform. Various online platforms are available, each offering its own unique set of features, benefits, and investment opportunities. Some platforms cater to specific investment strategies or loan types. So it's crucial that you find one that aligns with your financial goals and risk tolerance. Once you've found a suitable platform, the next step is setting up an account. This typically involves providing some basic personal information and linking a bank account for transactions. Keep in mind that some platforms may require a minimum investment amount, so ensure you're prepared to meet these requirements before proceeding. Now, with the account all set, it's time to dive into the exciting part: selecting loans to invest in. Each loan listed on the platform will include important details like the borrower's credit score, loan purpose, and interest rate. These details are crucial in helping you assess the risk and potential return of each loan. Remember, higher interest rates often mean higher risk, so balance is key. It's advisable to diversify your investments across multiple loans to spread the risk. Lastly, once you've chosen your loans, it's time to commit your funds. This is done by simply clicking the Invest button next to the chosen loan. After this, the platform handles the rest, collecting repayments from borrowers and distributing them among investors. You can sit back and watch as your investments generate returns. Remember, investing always involves a level of risk, so it's important to only invest money that you can afford to lose. Peer-to-peer lending is no different. While it can offer attractive returns, it's not without its potential pitfalls. So, always approach it with caution, do your research, and never hesitate to seek professional advice if in doubt. With these steps, you're well on your way to becoming a peer-to-peer lender. Before diving headfirst into peer-to-peer lending, there are some key considerations to keep in mind. Let's start with understanding the risk involved. Peer-to-peer lending isn't a bank deposit that's insured by the government. It is an investment, and like all investments, it carries a degree of risk. The primary risk is borrower default. If a borrower fails to repay their loan, you as the lender stand to lose your investment. To mitigate this risk, make sure you understand the lending platform's default rates and recovery processes before you start lending. Next, consider diversifying your investments. Just like you wouldn't put all your eggs in one basket, you shouldn't put all your money into one loan. Instead, spread your investment across a variety of loans. This way, if one borrower defaults, the impact on your overall portfolio will be minimal. Many peer-to-peer lending platforms allow you to invest as little as $25 in a single loan, making it easy to diversify your portfolio. Finally, consider the liquidity of your investment. When you invest in a peer-to-peer loan, your money is typically tied up until the loan is repaid. This can take anywhere from a few months to a few years. If you think you might need access to your money sooner, peer-to-peer lending might not be the right investment for you. Keep in mind that while some platforms do offer a secondary market where you can sell your loans, there's no guarantee you'll be able to sell them when you want to, or at a price that's favorable to you. So there you have it. Understanding the risk, diversifying your investments, and considering the liquidity of your investment are crucial steps in making a sound decision when it comes to peer-to-peer lending. By keeping these factors in mind, you can make better informed decisions in your peer-to-peer lending journey. Scene script. Like any form of investment, it's crucial to be aware of common mistakes that can be made in peer-to-peer lending. Let's dive right into it. One of the common missteps is not diversifying investments. Putting all your eggs in one basket, so to speak, can be risky. It's a bit like betting everything on a single number in roulette. The potential payoff could be enormous, but the odds are heavily stacked against you. Instead, spread your investments across a variety of loans. This way, even if a borrower defaults, the impact on your overall portfolio is minimal. Another common error is not fully understanding the risks involved. Peer-to-peer lending can be a lucrative venture, but it's not without its challenges. Default rates can be high, and there's always the chance of a total loss. Remember, the higher the potential return, the greater the risk. It's essential to have a clear understanding of the level of risk you're comfortable with before diving in. The third mistake is not doing enough research. It might be tempting to jump in headfirst, especially when you hear success stories of high returns, but it's crucial to do your homework. Understand the platform you're using, the borrowers you're lending to, and the terms of the loan. Read reviews, check ratings, and don't be afraid to ask questions. A less obvious but equally important mistake is not considering the tax implications. Yes, the interest you earn from peer-to-peer lending is taxable. So, ensure you factor this into your calculations when determining potential returns. Lastly, don't forget that patience is a virtue. Peer-to-peer lending is not a get-rich-quick scheme. It requires time and patience. Don't expect to see significant returns overnight. Instead, think of it as a long-term investment strategy. By avoiding these common pitfalls, you can increase your chances of success in peer-to-peer lending. And remember, every investor's journey is unique. What works for one may not work for another. So, always tailor your strategies to your individual goals and risk tolerance. So, are you ready to start your journey into peer-to-peer lending? We've walked through a lot over the past few minutes, so let's take a moment to revisit the key points. We began by uncovering the essence of peer-to-peer lending, a financial landscape where borrowers and lenders interact directly, without the need for traditional banking intermediaries. This platform has become a popular investment vehicle, offering potentially higher returns compared to conventional investments. We then delved into the process of participating in peer-to-peer lending. We talked about how to get started, from setting up an account on a P2P lending platform, to choosing loans to invest in, and finally managing your investment portfolio. Next, we highlighted some key considerations to keep in mind while participating in peer-to-peer lending. Remember, diversification is crucial to minimizing risk, and it's important to thoroughly understand the terms of any loan you choose to invest in. We also addressed some common mistakes to avoid in peer-to-peer lending. We emphasized the importance of not putting all your eggs in one basket, the need to steer clear of high-risk loans without sufficient due diligence, and the significance of keeping an eye on your investments. By understanding and applying these concepts, you're already on the right path to becoming a savvy player in the world of peer-to-peer lending. With this knowledge, you are equipped to begin your journey into peer-to-peer lending. We hope this guide has provided you with a solid foundation to start your peer-to-peer lending journey. If you found this content helpful, show us some love by hitting the like button and sharing it with others who might benefit. Don't forget to subscribe to our channel for more insights and guides on savvy investing strategies. And as you venture into the world of peer-to-peer lending, keep this in mind. The journey of 1,000 miles begins with a single step. Start your peer-to-peer lending journey today. The information provided in this video or communication is for informational and educational purposes only. It is not intended as and should not be considered financial, investment, legal, or tax advice. The content is based on general principles and may not be applicable to your specific financial situation or needs. Always consult with a qualified financial advisor, accountant, attorney, or other professional before making any financial decisions or taking any actions related to your finances. Any investments or financial decisions you make are solely your responsibility. Past performance is not indicative of future results, and there are no guarantees of any specific outcomes or returns. While every effort has been made to ensure the accuracy and completeness of the information provided, we do not warrant or guarantee its accuracy, reliability, or suitability for your individual circumstances. We do not endorse or promote any specific investment products, services, or strategies mentioned in this video or communication. Any references to such products, services, or strategies are for illustrative purposes only, and do not constitute a recommendation or endorsement. You should conduct your own research and due diligence before making any financial decisions. In summary, this video or communication is not financial advice, and you should not rely on it as such. It is essential to seek professional advice tailored to your specific financial situation and goals before making any financial decisions or taking any actions.